you've ever Googled how much should I borrow to buy a house, you've probably gotten a calculator that spits out a number and somehow you're more confused than when you started. But here's the twist. The real question isn't how much can I borrow, it's how much should I borrow? And let me tell you, for some people, those two numbers are very different. I'm Steph Douglas, founder of Open House Austin, an education-first real estate brokerage that has helped hundreds of people buy their first homes. And today I'm going to answer that question in a way that actually helps you make smart decisions and gets you into your home search with confidence. So back to the question, how much should you borrow? Let me tell you about two clients. Let's call them Alex and Jordan. Alex came to us pre-approved for $725,000. They felt thrilled, like, wow, the bank really thinks I can afford this. When we looked at their monthly numbers, we realized something important. Yes, the bank would lend them that much, but that would mean 45% of their monthly take-home going to housing, and that's before investment, that's before vacation, that's before the random life stuff that always comes up. Alex didn't need a bigger house. They needed more margin. So we adjusted their budget to the low 600s. Same neighborhood, slightly less square footage, and now they travel, they invest, and they don't panic when property taxes adjust. That's financial confidence. Now, Jordan. Jordan was the opposite. They assumed they could only afford around $350K because that's what their parents told them was safe. But Jordan had strong income, minimal debt, and $60,000 saved for the down payment. Once we ran the numbers with the lender, they were comfortably approved in the mid-500s, and more importantly, the monthly payment still fit under 30% of their gross income. Jordan wasn't overextending, they were underestimating. So let's break this down. When a lender decides how much you can borrow, they're looking at a few core things: your income, your debt, your credit score, your down payment, and current interest rates. The biggest metric they use is something called debt to income ratio, or DTI. Most conventional loans will allow up to 45 to 50% of your gross monthly income to go towards your debt, including your mortgage. But just because you can qualify at 50% doesn't mean you should live there. At Open House Austin, we typically walk clients through three numbers: your max approval number, your comfortable number, and your stretch but still sleep at night number. At the end of the day, buying a home is also a lifestyle choice, not just a math equation. To balance the lifestyle choice and the math equation, there are a couple things you need to consider, such as down payment and household income. Your down payment does change your borrowing power. A larger down payment lowers your loan amount and lowers your monthly expense. But I'll be honest, most of our buyers are not putting 20% down. They're putting 3 to 10% down strategically, keeping cash in reserves, and planning to refinance if rates shift. We've worked with couples, friends buying together, siblings, unmarried partners, solo buyers with strong W-2 incomes. When you combine your incomes, your buying power increases significantly, as does shared responsibility. But that's a conversation between you and your buying partner. And then there's Austin specifically. Property taxes in Austin are no joke. They can materially change your monthly payment, which is why when someone says, I can afford a $600,000 house, I ask, in which tax rate? Because $600K at a 1.6% tax rate versus a 2.4% tax rate is hundreds of dollars per month difference. So back to our main question, how much should you borrow? Technically, a lender will give you a maximum budget based on your DTI, credit, and your down payment. But the way you should really be thinking about it is what monthly payment aligns with the life that I'm building. Do I want flexibility to invest, to travel, to have kids, to adopt 3 dogs, start a business, host dinner parties every weekend? Your mortgage should support your life, not dominate it. If you're watching this and you're thinking, okay, Steph, but I still want a ballpark, here is a rough framework. Take your gross monthly income, that means before tax, and multiply it by 0.28 to 0.35. That range is typically a comfortable monthly payment for most buyers. That includes principal, interest, taxes, insurance, and HOA if it applies. Then work backwards from there based on today's interest rates. If you really want to go into this with confidence, then do this. Get fully pre-approved, not just pre-qualified. Then have a strategy conversation with your agent and your lender. Because at the end of the day, this is a puzzle that can be put together in many different ways. And a good agent and a good lender will help you do this. Most buyers don't really realize that. So I'll leave you with this. The bank will tell you what you can borrow. We can help you decide what you should borrow. If you want to know your real number, the one that fits your goals, not just the lender's algorithm, book a call with us. Or leave your questions below and tell us your biggest fear about buying. Because once you understand your borrowing power, the whole process feels a lot less intimidating, and that's when things get interesting and fun. If you're in Austin, check out the link in our description to join us live and in person for our next How to Buy a House workshop, where we'll review the mistakes to avoid, how to buy strategically, and how to really navigate the Austin market. And even if you're not in Austin, we're here to answer any questions you have. Add your questions in the comments so we can answer them in our next video.